Steve, did you put them up to this? You guys are ridiculous. You guys learning a lot? Yeah. All right, good. All right, what I want to do is I actually, instead of teaching a technique, I want to talk about a strategy. So something different, and my talk today is actually why options are better than stocks. So I want to do a deep dive into this subject. I've talked about it very on a surface level, but now I want to go into it in much more detail. So hopefully I can figure out how to do this. There we go. All right. So the assumption in everything I say is that you're only buying undervalued options and selling overvalued options. So every time I say buy a call, I'm assuming that you're only going to buy an undervalued call. And when I say to sell an option, the assumption is only an overvalued option. Is everybody with me on that? All right, so I'm not going to mention that anymore. Let's just make that an assumption. So the first big advantage that options have over stocks is that they're cheaper. So for example, it may cost me $5,000 to buy 100 shares of a $50 stock, but the same option, an option on that, I can probably pay a few $100s. Now, well, what if the call is $2,000? You know, what if it's a $200 call? Go more out of the money. So my usual rule of thumb is that I like to buy options that are just one strike out of the money with a 40 delta, something like that. But you can go to a 30 delta. You can go to a 20 delta. In other words, you can buy an option that's really, really cheap. You can buy an option for $50. Now, the stock has to move a tremendous amount before you can make a tremendous amount. Does everybody follow what I'm saying? Like, if let's say the stock is a $50 stock, if I buy an option that's going to expire in the next couple of months, and let's say it's 5 strikes out of the money, or let's say it's like 60, I may only have to pay $100 for that option. But this is one of the critical things where people make a mistake. Let's say it cost me $100 to buy that option, and it's a 60 option, and it expires in 2 months, let's say. Now, what are the odds that it's going to hit 60 or 61, because it has to go to 61 before I break even, right? So what are the odds it goes to 62 and I make some money? Well, probably pretty slim. Would you guys agree with me on that? Yeah. Probably pretty slim. So what happens is that people look at the market and they say, well, it's at 50 now, it only cost me 100, which is good, but the problem is it's got to go up to 61 before I break even, so I'm not going to buy it. Well, that's a true statement only on the last day of trading. That's a true statement only on the last day of trading. You see, what if I buy that option, the 60 option, and let's say it's a 10 delta. Everybody knows what a 10 delta is now, right? You're all experts on deltas? Okay, so what if the price of the stock goes from 50 to 51? What's the value of the option? Remember, I bought it for $1. What's it worth now on day one? I made 10% in one day. What's wrong with that? Do you see what I'm getting at? So the point is that I'm going to make 10 cents and then I'm going to lose a penny on time decay. So I'm really only going to make $9. But the point is, now I've got something with not a delta of 10, but a delta of 11 now. Are you following what I'm saying here? So the point is that people get wrapped up on what's called the probability distribution or the returns on the last day of trading. Who cares about the last day of trading? You don't have to carry it to expiration. When I put on an option, I assume that I'm never going to carry it to expiration. So my point is, if the price of the stock goes from 50 to 55, I've probably made a 50% return on my deep out of the money option. 50% returns, pretty good. You following what I'm saying? And then get rid of the option. Get rid of the option. You don't have to carry it to expiration. So one of the key things here is just because it's deep out of the money doesn't mean we can't make a very high percentage return. And in fact, the stock doesn't have to move very much. Like I say, if it moves up $1, we've made 10% on our money in a day or two. Now, I know your bank is paying you much more interest than 10% for every 2 days. I'm sure your bank is doing that. Does everybody follow what I just said? You need to look at options as a dynamic instrument. I'm going to get to this later in this presentation. But, don't ever think of options that you have to hold them all the way to expiration. You don't. You merely need to hold them until they no longer are going up. And then you get rid of them. So everybody can afford to invest in options. Not everybody can afford to invest in stocks. Yes, you can buy one share of stock, buy it for $50, pay $6 commission in and $6 commission out, and guess what? You have to make a 25% return to break even. So you see what I'm saying? You need to be able to buy a certain critical mass of dollars to cover the commissions. So this is a critical thing, being able to buy any option for just a few $100s. That is a big advantage. Now, what that means then is people with smaller accounts can trade stocks. They can't trade all stocks. They can't trade small cap stocks. Can only trade some mid cap stocks. But you can pretty well trade any large cap stock using options. So you don't have all 13,000 stocks that are available in the United States, but you do have a couple thousand stocks available that you have enough liquidity to trade options. So people who've got $2,000 in their account or $1,000 in their account or $5,000 in their account can now trade consistently all the time using options, out of the money options like I just described, but they can still get involved. Now, bigger accounts have a different advantage. Bigger accounts can now diversify. So a bigger account can afford to buy 100 shares of a $50 stock and invest $5,000. But guess what? With options, now they can have 20 stocks in their portfolio and never even think or worry about liquidity. They won't have to worry about diversification. They can have 100 stocks in their portfolio for a bigger account by using options, whereas they may be only able to afford 20 stocks if they don't use options. So the opportunity to diversify, I look at diversification, everybody looks at diversification, buying 30 stocks is safer than buying 3 stocks. When people talk about that kind of a diversification, they're talking about what's called non-systematic risk. Now let me translate this into English, all right? Systematic risk is the risk of the stock market. Non-systematic risk is the risk of the stock. So when people say, well, if I have 30 stocks in my portfolio, I've diversified my risk, all they've said is, and this is a subtitle, you gotta have a subtitle, I don't know shit about picking stocks, so I bought 30 stocks, so now all I care about is where's the stock market going. That's what I'm translating what they're saying into. I like non-systematic risk because I think I can pick stocks better that perform better than the market. So to me, diversification is diversification, and we don't want that kind of diversification. What I look at is that if I can pick stocks that outperform the market, then I look at it as 30 probes. 30 probes. You see, when people diversify, they diversify, in my mind, incorrectly. They just go out and they say, I'm going to have 3% of 30 stocks. That gets me 100% of my portfolio, right? And they're all going to be equal weighted. Now, I look at it and I say, let's start out from day one. I probe the market. I buy 30 different stocks. Now, I don't know which ones are going to do great. I don't know which ones are going to do terrible, but I've got 30 probes in the market. So what's going to happen? Well, let's say 10 of them I lose money on. Okay, I lose my risk management limit. I lose a little bit of money. In this case, my options would expire worthless. Then let's say I've got another 10 stocks, and let's say they make a little money. So they pay for the losses. But now I've got 10 stocks which will do much better. So what do? I take that capital that was in category 1 and category 2, and now I start to put it into category 3 and ramp up my position. Do you see what I'm saying? Plus I have some more money still available for probing to find some more big winners. Some will be losers, some will be winners, but guess what? Every so often I get the big winner. So in other words, to me, yes, I'll buy 30 stocks like that mutual fund manager, but to me, I'm not trying to diversify out the risk. I'm trying to accentuate the risk. I'm trying to get my money out of boring stocks and into good stocks. Do you see what I'm saying? But I need to probe the market and see if the market agrees with me or not. Well, with options, I can probe the market for a pretty cheap price, a few $100, and I control 100 shares of stock. Now, if I'm buying something that's 5 strikes out of the money, I may make a high percentage win, like the example we just said. Maybe I can make a 50% return on my money. That's fabulous. But of course, what I'm hoping is that that particular stock takes off. I'm able to pyramid. I'm able to add more and more options and start to make some really big money. 1,000% on that stock. I only invested $100, $200. So still, if I can go from $200 to $2,000 on 10% of my trades in a year, I only had a $2,000 account. Now I've got an $8,000 account. You see what I'm saying? So to me, I don't look at having 30 stocks in my portfolio as diversification. It's probes so that I can move money to where the market is rewarding and take it out. So it's not diversification, it's probing. Am I making sense here? So clearly, if you've got more money, you can probe better. If you have a smaller account, maybe you can only put on 5 probes at a time. So maybe one of those will turn out to be a big winner, 2 losers, 2 little winners. They wash, we make our money on that 5th trade. Am I making sense so far? All right, good? All right. Now, another big advantage of options is the concept of trading without stops. And this is of really, you basically buy a put instead of using a stop loss. And once again, remember, I'm assuming that you're buying an undervalued put, not an overvalued put. So in a lot of cases, if it's an illiquid option, you should just assume that you're going to lose the whole premium. I put it on, I put on a stock. I know I'm allowed to risk $300. So I can buy 2 $150 puts or 1 $300 put, or once again, you need to pick which is the correct option. But the point is, you now sit down and say, I'm willing to spend $300 in premium on the option. So I was willing to risk. Now, instead of risking that amount when it goes down and hits my stop loss, I spend that loss on premium. Now, this has a lot of advantages. Number one, you've got a shot at making some big money without getting stopped out. So what happens is the market goes down and we get stopped out and we have a loss. Okay, I'm fine with losing money. That's okay. But wouldn't it be better to have the market go down and you still have a shot that it might turn around and start to go back up? Well, with a put, you can do that. With a regular stop, the market comes down, you get stopped out, you have to wait for it to turn around and then go rebuy it at a lower price, which is a great strategy, by the way. I'm not saying that isn't a good strategy. But if I use a put, it can go down, I'm not stopped out, and then later come back up and make me money. Now, the odds of that happening are not high. Let's be realistic. If something goes down below the stop point, that's usually a signal that the trend has turned bearish and we're not going to make money. But at least I have a shot. With a stop loss, I have no shot at all. Am I making sense here? Right? It goes down, I'm stopped out, I'm out of the trade. Goes down with a put, I still have a shot that it turns around and goes up. Now that may only happen 10% of the time, 20% of the time, but that still means you're going to be making more money. Now there's other things that can happen, is that if I use a put instead of a stop loss, let's say the market goes down and I get below where my stop loss would be, if I'm really convinced that the market's going to continue to go down, I can sell the put, and maybe my loss is not as big. Maybe I can still get some of that money back, that maybe 10 or 20 or 30 or 40 or 50% of the put value, I can get that money back. But if I'm stopped out, my stop is my stop, and I've lost the money, and there we go. So the put is always preferable to a stop loss if there's liquidity in the option. Always better. There's no example where it's worse. Not one. I might be able to get some premium back, and I have a shot at having a profitable trade. Now, neither one of those may occur, in which case all you are is the same as if you had a stop loss, right? If neither one of those things occurred, then you're no worse off than if you'd put a stop loss in. But one of those two things is going to happen, maybe not the majority of times, but maybe 20, 30, 40% of the time. So, let's say 10 to 40% of the time, you're going to always be better off. So at the end of the year, using puts instead of stop losses will always make you more money, or more importantly, lose you less money and give you a shot at making money. Economically, you always have to be better off using a put than a stop loss, as long as the premium invested is the same as what your stop loss would have been. Okay, does that make sense to everybody? So that, to me, is a huge advantage. Now let's take a look at this same point and let's discuss it from a psychological perspective. I know nobody in this room has ever canceled a stop when the market came down and got close to it. Right? Dead silence. Okay, all right. I get the message, all right? So here's the thing. People, when the price comes down and is about to hit their stop loss, what happens? There's a famous joke. Well, yeah, my stop loss, I have a cancel if close order in. So if the price gets close to that, well, it cancels the stop loss. Now, of course, there is no such order, but guess what? A lot of people get into their trading, and when it gets close to that stop loss, they cancel the stop loss and then have a big loss. That's not an uncommon problem. But what I found is, and of course people do that because I'm right and the market's wrong, so I don't want to get stopped out. Because I know the market's going to turn around, and then after a few days they go from I know to I hope the market will turn around, right? That's how the psychology goes. But the words I hope are banned from the English language from now on. Does everybody got that? All right. And I'm not even sure I like the word I know, but let's carry on with that one. So the point of this is that there's a psychological effect as well of buying a put rather than using a stop loss. People, for whatever reason, if I sit down and I get stopped out and I lose $1,000, that feels bad. But if the put goes down, if the price goes down, the put's making me money. So it doesn't seem as bad. And because the put everything's happening in slow-mo, I can psychologically adjust to the fact that I'm losing more money on the stock going down than the put is going up. I can hide from the reality that I'm losing money easier using a put, because I psychologically can look at the put and see, whoa, the put's making me money. So I got one losing trade and one winning trade. That's not so bad. Do you see what I'm saying? This is hallucinating because the loser is bigger than the winner, but it's psychologically easier. And that's all I'm talking about is psychological ease, not reality. So what I'm saying is that the use of the put has this additional psychological benefit of it doesn't feel as bad while you're losing money. So your confidence stays up and you put in the next trade and all of those sorts of things carry on. Is that making sense on this? Awesome. Okay, this is a really, really important one as well. There are multiple ways to make money. If I buy a stock and it goes up $1, how much money do I make? $1. And if it goes down $1, how much do I lose? $1. Okay, easy enough. But options have multiple ways of making money. And one of the reasons I think that people don't trade options is because there are multiple ways to make money. In other words, I sit down and go, oh, now I got to think about all these other ways to make money. Now, you don't actually have to, but it's a huge advantage because now you can start to not only find ways to make money, you can fine-tune your ways to make money. So let's take a look. Direction. When I buy a stock and it goes up $1, I make $1. That's trading direction. I want it to go up. I don't want it to go down. So I've made a decision when I buy a stock that I believe it's going to go higher. Yes or yes? All right. Now, furthermore, let's just stop and think. What am I thinking in my brain when I buy a stock? In my mind, implicitly, I'm saying, I'm buying 100 shares of IBM. I think it's going to go higher. Right? Am I right on that? That's what's going on in our minds. But an option trader has to think more deeply. Another reason why people don't want to trade options is because to maximize your profit in options, you actually have to think a little bit harder. So instead of just making a decision that it's going up, an option trader is going to want to sit there and say something like, I believe the market's going to go up by $10 a share in the next 60 days. How much and when? Most stock traders, we just say it's going up, and we don't ever ask the question of when and how much. Yes or yes? Right? We just say it's going up. But an option trader should take that extra step and say, how high is it going to go in what time? This is incredible. That question does a lot of things. It forces you to start to think deeper about markets. Not a bad thing. This indicator that I'm looking at, indicator A, says that the market's going to explode higher. This indicator on another stock says that the market's going to drift higher. Guess what? Two different markets, two different scenarios. Should be two different strategies, don't you think? You can do that with options. You can't do that with stocks. If it goes up $1, you make $1. If it goes down $1, you lose $1. That's the deal with stocks. But here, let's use an example. If I believe that this market's going to explode, I believe the phase 3 trials on this particular biotech are going to come in and get approved, and this stock's going to go from 50 to 100 in the next 3 weeks. I should probably buy a bunch of out-of-the-money calls, right? Because they'll all be out of the money, and then when my scenario is through, they'll all be in the money, and I will have made life-changing money. I will have made a huge, huge amount of money. Okay, I got another stock. This stock is going to climb by 50%, but it's going to take a year. It's going to be, that's a pretty bullish stock, 50% gain for a stock, but it's going to take a long time. Hey, well then maybe a covered call is a better strategy. Because if I sell, let's say an out-of-the-money call, and I buy the stock, and the stock just grinds higher, I could make money on both the long stock and the short call. I could be doubling my profits and reducing the risk. Because I'm short, I have a bearish thing, which is the short call, and I have a bullish thing, which is the long stock, and they offset each other if you construct it right. So, wait a minute, isn't that the holy grail? Increasing profitability by reducing risk? You see what I'm saying? But on the other hand, if I think that stock B is going to explode, a covered call is not a very good strategy at all, because I'm capping or truncating my profits. So that would be a pretty bad strategy. But by taking the extra step and just projecting what the stock has been doing into the future, we can start to get an idea of how we can increase our profitability and decrease our risk at the same time. Once again, very unusual thing to do, but if I have a scenario, now I can start to make that decision. Well, what if my scenario is wrong? What if my scenario is wrong? Well, let's take the two scenarios again. What if I have the explosive stock and it turns out that it just goes higher? Well, I need a follow-up strategy, and I probably don't want to be, unless it moves up, just as my first example, if it moves up, even if I have a lot of out-of-the-money calls, I can still be making a lot of money, but I probably have to get out of them before expiration or before the time decay starts to kill me. You see what I'm saying? Because it probably isn't going to be in the money at expiration. Okay, so what can I also do? I could roll down. I don't have to be deep out of the money. I could go into at the money. And then I start making money right now. If my scenario is wrong, I react. I change my strategy to at the money or one out of the money. I don't stick with something that's way out of the money. So that's another way that I can adjust. Okay, let's take the other example. Well, what if I get into a stock that I thought was going to grind higher, but instead it starts to skyrocket. It's just jumping and jumping and jumping. I better get out of that covered call, right? We assume that the options are overvalued, so I just sell my calls and just go naked long the stock. I don't flip to buy a call because we did the covered call because the options were overvalued. So we just get out of that call, stop truncating or capping our profits, and just let the stock run. So I'm hurt if the scenario doesn't work out exactly the way I want it to go, but I'm not hurt badly. I'm hurt in the way that I don't make quite as much money. I'm not losing money, but I'm not making as much money. So as long as we identify that we were wrong in our scenario quickly, it doesn't hurt very badly. But if we're right, we gain so much more. So when I look at it, I say, well, if I use the deep out of the money calls on stock A, and I'm right, I make a ton of extra money. And if I'm wrong, I lose a little bit. I need to change my strategy. For stock B, the grinder, if it all of a sudden accelerates, well, if it does what I think it's going to do, I can maybe even double my money or certainly make tens of % more by being short the call and long the stock. If I'm wrong, I better get out quick. I gave up some of the profits, a little bit. My point is the risk reward is dramatically in your favor by making that one additional step. How fast, how high, how quickly? Answering those questions. Let me get to one last advantage of asking these two questions. Think of how educational that is. Because in your trading journal, of course, you'll write down what your scenario is, so it's on paper, and you can't come back 3 weeks later and said, I knew this was going to happen. No. You're not allowed to come back after the fact and say, I knew that was going to happen. You've got to write it down as soon as you think it, okay? So you're accountable. But what it does is it causes you to think even more and more deeply about markets. It makes you think more and more about what impact does certain indicators have on the market. Is momentum strong? Is momentum weak? Is the trend strong? Is the trend weak? Would be two simple examples of, we always assume that what's in place now will continue going forward. Something in motion tends to stay in motion. Or to use the trading expression, the trend is your friend until it ends. We'll leave that part out for now, all right? But the point is that generally speaking, if you have a sharply accelerating stock, it will sharply accelerate for a certain period of time going forward. Of course, every trend ends. But probably it's good for one more day. And then at the end of that day, if it's still going, it's probably good for one more day. The point is that by forcing you to think more deeply, it's always going to make you a better trader. You'll sit down and you say, I believe this stock is going to go up $20 in the next 30 days. We'll come back in 30 days and see how well you did. And guess what? A year from now, you'll be doing it a lot better than you are now. What does that mean? You make more money. And the better you get at it, the more money you make. That's incredible. A second thing that you can do with options, as I say, is you can trade direction just like you do with a stock. So that's roughly the same. Although, as I just explained, there's lots of ways that you can modify it. But we can also trade just the volatility of the stock without having any opinion of the direction. This would be a delta neutral strategy. And all we're doing is trading the implied volatility of the stock. We're not even trading the stock. Like, I don't even care what the stock is. Just show me a chart of the implied volatility. Now, what's really cool about the chart of the implied volatility is that it is nearly always range bound. What do I mean? It's in a trading range. Well, that makes it much easier to trade than trading direction. You buy the low, you sell the high. You buy the low, you sell the high. In many stocks, you can do that 5, 6 times a year by using delta neutral strategies or strategies where you don't really care where the market's going. You just want to know where's the implied volatility going. As I'm speaking to you right now, we're at multi-year lows in implied volatility on the S&P 500. Multi-year lows. Well, we know one thing, it can't go to zero. I know if it goes to zero, we've had the biggest depression and we're in a war and we're all dead, so who cares? But we're at an unbelievable low point, which tells me that I need to be long implied volatility in the S&P. Now, and I don't care what the direction of the S&P is. I don't care what the time decay is. I don't care about anything except the implied volatility of that market. So right now, a great trade, as I'm doing this right now, is to buy S&P implied volatilities. That would be things like buy a strangle, buy a straddle. Those would be the type of long volatility trades that you can do. And because you're long and short options, you don't care so much about things like the gamma or the time decay as much. Now, you actually are more concerned with them. But you're no longer concerned what the direction of the market is. There's a term used in the financial community called asset classes. So what does that mean? Stocks. If I were to go find a professor right now and grab him and say, tell me what an asset class is. Well, they'd say things like the stock market is an asset class, the bond market, real estate, cash. And if we're only looking at the investment world, they would only say stocks, bonds, and cash. But what have we done? We've created a new asset class called implied volatility. So now you've got a fourth asset class that other investors are not looking at, because the implied volatility is not necessarily correlated with the direction of the market. So that I can put on trades in the implied volatility and the stock can go up or it can go down. And guess what? I really don't care. I'm delta neutral. I'm neutral to the direction of the trade, because that's what the delta is, isn't it? It measures the sensitivity of the option to the change in the price of the underlying. So by having trading delta neutral, now I've created a whole new way to make money and lose money, but far less frequently than the direction, because guess what? Implied volatility goes up and down, up and down. It is what is called mean reverting. It goes back and forth across the average. You sell at the high, you buy at the low, you sell at the high, you buy at the low. Most stocks will go from low to high 5 or 6 times a year. So you got 5 to 6 new trades. Do this strategy with big liquid stocks so your transaction costs are small, and you don't really care. Apple, it's going up. I don't care. Now, you have to realize, as an option market maker, and I was an option market maker, all I did was trade implied volatility. I didn't care if the market went up or down. That's not my job. As a market maker, I need to be balanced long and short. I need to not care if the market goes up or down. I need to buy at the bid and sell at the ask, but more importantly, I need to make sure that I'm buying at low implied volatility and selling at high implied volatility. And so my job was really to manage a book of billions of dollars of implied volatility, not trade the direction of the market. That's a speculative job. That's not what banks are supposed to do, and I was a market maker for a bank. So implied volatility is a whole new asset class. Now, you can also construct trades that are effectively delta neutral, again, and capture the time decay. We know that options are wasting assets. Their value goes down every single day, and of course, in that last 6 months of its life, it starts to accelerate, and it starts to be a big number every day. Well, guess what? What if I sold an option that was about to expire and bought an option that had months before it expired? Could I come up with a combination of those options that eliminated my risk to direction. Could I do that? Absolutely, I can do that. So that now I have a strategy which makes me money, and the strategy, by the way, would be a calendar spread, but it would be weighted. You wouldn't do 1-to-1, you would actually weight it so that you don't care what the direction is, and all you're doing is you're focusing on capturing the time decay that occurs every single day. That's why you short something about to expire, because the time decay is accelerating as we get closer to maturity, and you buy something far out. Well, that sounds like free money to me. Unfortunately, it's not, because if you're wrong, you're also what we would call short gamma. So you can be quickly wrong. So you need to have, when you do a trade like that, where you're weighting all these things and you're capturing a lot of money every day, if you're wrong, you need to be able to pull the trigger very quickly. You got to have the intestinal and mental fortitude to get out of the trade quickly. But don't forget, that's not likely to happen because you are delta neutral. So let's say I'm short 5 options with a 20 delta, and I'm long a deep in the money option with 100 delta. What's my net delta? 0. Now, if the market, I'm short, so if the market goes up, let's say it's calls that I'm using, then these will go deep into the money quicker and I won't be delta neutral. So we have to always be worried about gamma. Gamma is what we're paying. The risk of gamma, I should say, is what we're paying in order to get a massive amount of time decay every single day. So my point is, now we've gotten rid of implied volatility. We don't care about that anymore. We don't care about the direction. What we care about is the time decay and the gamma. So we've created a new asset class. Do you see what I'm getting at? Once again, completely diversifying, true diversification of your portfolio, because it's not correlated with anything else happening in your portfolio at all. It's a new asset class. To me, the most powerful thing is the ability to sculpt your returns to what your outlook is. I gave the simple example a few minutes ago of, well, what if you think the market's going to skyrocket versus grind higher? That calls for different strategies. You might say something like, well, you know what? I think that this stock, IBM, is going to come under pressure here during the summer months, but that the seasonal pressures will cause it to move sharply higher in the fall. Would that be a type of scenario that you could imagine in a big blue chip stock right now? Does that make sense? Guess what? You can't do that trade in the stock market. You'd have to go short now and then long some other time. But you can construct a trade right now that makes money on that scenario. You see what I'm getting at? So you can sit down, create the scenario, and then create the strategy to create returns based on down now and higher later. We can make that trade up right this second. You can't do that in the stock market. The stock market is so linear and binary. It doesn't allow you to sculpt the returns in a way that allows you to capitalize on different scenarios. You could construct a strategy that says, you know what, I really think that General Motors, because of this ignition problem, it's going to go lower near term, and it's going to go down too far. People are going to be too depressed about the value and how the ignition problem is going to hurt them. And then we're going to see monetary stimulus, and the price of General Motors is going to go up in the future, and we can construct a strategy to take advantage of that right now. So whatever you think the scenario is, you can create a strategy right now to capitalize on it. You can't do that using anything but options. And of course, the reason is because the options are all curves, right? You know what I'm saying? And because they mature at different time periods means that we can look at the future by expiration. What's going to happen when? And that's unbelievable power. Does it require more thought on your part? More than a tad, all right? A little bit more than that. But I would argue that it's not hard work. It is time consuming. I'm not going to say it's not. But on the other hand, it's not hard. It's just simply looking at the Greeks, adding them up in the way you want them to be. It's a simple process. It is time consuming to look at all those puts and calls and then figure something out. But there's ways of shortening that. If I'm doing a calendar spread, I know I only want to be short options that are close to maturity. So I don't have to look at all those long-dated options at all. And I want to be long an option, well, I don't have to look at any of the short-dated, and you know what, I don't need to go a full year out, so I can just say 6 months out, that's good enough. You see what I'm saying? So we can use some simple rules of thumb to reduce our decision-making process so it doesn't take too much time. Now let me come to my final slide. One of the things is that there's a couple of things here. What trading options does is force you to look at the stock from a holistic point of view. You get a holistic vision of the stock. It forces you to think deeper and harder about what's going on. You don't have to, right? If I'm bullish, I can just buy an out-of-the-money call and I can keep it simple. But if you look at options in a holistic manner, if you look at the underlying instrument in a holistic manner, now all of a sudden all kinds of opportunities for making money present themselves. Tremendous opportunities. As a professional trader, my next point there, you'll see it says you really never exit. Let's use Apple as an example. Apple's in a bull market right now. But Apple was in a bear market a few months ago. So let's say 6 months ago, I was really smart, and let's say the options were undervalued and the market was going down. And implied volatility was low. So a simple strategy is to buy a put, right? Yes or yes? Make sense? All right. Then let's say the implied volatility gets really high, but it's still a bear market. Well, now what do? I'm long these puts. They're now deep in the money. Well, I could flip them and sell them. Now I have, are you ready for this? I would sell them and sell the stock short. So flip the position into a covered put right, which is the opposite of a covered call, right? Sell the stock, sell the put is the same as, it's the equivalent strategy as a covered call. Now, what if, let's take another scenario. What if those options are now deep in the money? I'm so successful, I bought those options, they're deep in the money. Do they have a high time premium? Yes or no? If I buy a put and it goes deep in the money, is there much time premium in the option? No, there isn't. So if there's no time premium or very little, do I care what the implied volatility is? No, because implied volatility only changes the value of the time premium in an option, not the intrinsic value. So I could just keep the put on. Even though puts are now overvalued, because it's deep in the money, it doesn't matter. It doesn't matter. So now what could I do? I could turn it into a spread by selling a further out of the money. I could buy a call to act as a stop loss on my long put if the calls were undervalued. Am I making sense here? Now, so what happens then is that as a professional trader, I don't really liquidate the trades ever. I just keep adding more on. So I get up in the morning and I go like, oh wow, I'm long this put, but implied volatility has gone up. It's gone up. So, but today I'm more bearish than I was yesterday. So I think I'll naked short a call. Okay? I think I'll naked short a call because that's a short volatility, short directional trade. So now I've got two trades on. But what did I just do? If I sell a call and buy a put, that's called a reversal or a reverse conversion. So I've really put on an implicit futures contract on the stock. Now they could be at different strikes, so I call that a split strike reversal. I know this is getting a little mind-boggling here, but you mean you guys aren't visualizing this? I'm seeing it looking like this. I know exactly what the chart looks like. But the point is that then you wake up the next day and you say, I'm not as bearish today as I was yesterday, but I still think the implied volatility is overvalued. So what do? You liquidate part of the trade. I'm not as bearish, so fine, buy back some of your puts. Buy back some of your buy back some of the puts because you want to be you still want to be short volatility, but you don't want to be as bearish. So if you had 5 puts, buy one back. So every day you get up and you go like, well, what do I think about this? Oh, that put, it's not deep in the money. My time decay is starting to hurt me. I think I'll roll forward and roll down. So I take my May option that's about to expire, my time decay is killing me, and I roll it out to a September option. So now my theta isn't hurting me, but I'm still as delta short as I was before. I've just moved my option portfolio around. And I could spend hours talking about the maneuvers you can do, but just ask yourself a couple of questions. I get up in the morning, what is my opinion on the direction of the stock? In other words, when and how quick? What's my opinion on implied volatility? And what's my opinion on time decay? Now, of course, we always want to be receiving time decay, but then we have the risk of gamma. Sometimes I'll pay the time decay in order to get the benefits of gamma, because they kind of are a trade-off. But what's your opinion? Well, I'm starting to get killed by time decay. You probably shouldn't be in that option anymore. You should probably be in a different one. The thing is that what options do is to create so many new opportunities. I look at putting on an option strategy as not just caring whether the direction is up or down, but I definitely am going to have an opinion on implied volatility and probably have an opinion on time decay. And so as a result, trading with options and the way you put them together, I want a strategy that makes me money on time decay and makes me money on the implied volatility going up. I want to do the reverse. No problem. I want to mix and match those in any way, shape, or form, and with options you can do that. The ability to construct a strategy that takes into account direction, implied volatility, time decay, and gamma, and I can construct a strategy that could make me money on all of those things at the same time. At the same time, I can change my mind tomorrow and eliminate. I can nullify one of those factors. I can nullify one of those factors anytime I want by adding or subtracting an option into the strategy. And this is what I mean by holistic trading. It's because you now don't look at the stock from a simple up-down perspective. You now start to say, where is it going and how is it going to get there? In what period of time, and now I need to find the option that fits that scenario, those decisions. As I say, it's not hard. It is a little bit time consuming because there's a lot of choices. But once you get the experience, you get the rules of thumb that say, I need to go here. And then I only have to decide between 2 or 3 options. I don't have to look through 300. I just need to look at these to get where I'm going. And that comes with experience. So this is what I'm saying. You now start to look at a stock in terms of the direction, up or down. You start to think of it, is it a volatile stock or a boring stock? And then you add in the options, the time decay, and the gamma. And now you've created whole new ways of making money that you couldn't do with the underlying stock. And your understanding of the pattern or the flow of that particular stock goes up dramatically because you're thinking about things like volatility and then reducing that down into a strategy. And then once you're in that strategy, probably don't exit, just modify it. Just modify it. If you go from you're bullish to bearish, leave the old strategy on, just add some new options. Let them expire worthless or whatever so you don't even have to pay the commission on them when they expire worthless. Save yourself a couple bucks. So options to me, if I sit down and say every single day when I look at something, I'm saying, is there a better option strategy than just simply buying the stock? And guess what? The answer is always yes, with the exception of liquidity. As long as there's liquidity, if there's no liquidity problem, the answer is always an option is going to be a better strategy than a stock. And that's the only time when it's an illiquid option that you should think about buying the stock. Otherwise, take the time and think about how can I actualize other and new ways of making money? How can I create a strategy that gives me more reward and less risk? And you can do that with options. You can't do that with stocks. I'm through. Thank you very much, everybody. Hey, I really hope that you enjoyed that. I really did a lot of thinking before I put together that presentation. And as you can see, I'm a big fan of options. I really believe they have so many advantages and that it's almost impossible to find a situation where an option strategy isn't better than a stock strategy. Now, if this is interesting to you and if you want to explore this further, we've got a fabulous live seminar. I'm going to show you a video about it, but anyway, I just wanted to thank you for coming and watching the video, that free education that I just gave you. Please stay tuned if you're interested in learning more about how you can utilize options to really crush the market. So hang on, watch the next video. Thanks. Hey, Courtney Smith here, and I want to announce the most incredible options trading education ever. I was recently searching the internet to find some education on options. I wanted to find a great site with great education that I could refer my clients to. This may sound odd since I am the author of a well-respected book on option strategies, but I didn't want to force my students to buy a book by me. I wanted to give them an easy way to learn about options. In addition, I didn't want to spend time giving basic education. It's not my thing. I wanted to instead to focus on advanced profit strategies. I found optionsuniversity.com. optionsuniversity.com. It was filled with great information on how to trade options. It had basic education as well as advanced education and trading advice. I thought it was great. In fact, it was great. So I bought the site. That's right, I didn't sign up for the courses. I bought the whole company. Yep, I now own optionsuniversity.com. So I have cherry-picked some of the greatest information from the site and put it together into a live seminar. I'm so excited about this course that we will teach you how to trade options using my money. Live trading, that's right. We will live trade the strategies that we teach you in front of your eyes using my money. More about this later, but first I want to tell you about some other great things about this course. This is a live 5-day seminar taught by me and some great instructors from Options University. The course will be taught in our brand new classroom that we built just for teaching trading, including options trading. I'll also tell you more about this in a minute. But first, let me tell you about this super cool seminar. We'll start out by talking about the psychology of trading. Why? Because the psychology of trading is the hardest part of trading. We'll then show you how to control risk in your trading so you won't have any large losing trades. You will learn to control risk so risk won't control you. Then we will dive into hardcore options trading strategies designed to help you profit in the markets. We then teach you the basics of options. You may be saying that you already know the basics, but trust us, your understanding of options will be much deeper when we finish teaching you about what we know about options. We have two major approaches to trying to create profits in options trading. First, we want to make massive money. So we show you how to put on trades that can turbocharge your profits. We combine our proprietary trading methods with options to create the potential for massive profits. The cool thing is we have this opportunity to make a huge amount of money, yet we'll have limited risk on the inevitable losing trades. Our trading methods are some of the same ones I used to build a track record as a successful money manager, including managing the #1 mutual fund in America and the #1 global macro hedge fund. We will reveal those techniques to you so you can also use those techniques. Nothing will be held back. You will get simple to use rules and concepts. But adding options to these indicators gives the profit potential to another level. Options are leveraged.
An investment in an option on a stock means that you are controlling an investment in 100 shares of that stock. You can usually invest a modest amount of money to control those 100 shares. The result is you have vastly more profit potential trading options than compared to the underlying stock. At the same time, you can construct trades which limit the risk of loss automatically. High reward potential with limited risk. Now that is super sweet. So we will show you my super cool trading techniques and then show you how to turbocharge them using options. Second, we want to make consistent money. You see, it's great to make big money, but that may not happen very often. So I think you should also be making consistent money. We want to show you techniques that are designed to create consistent money. You probably wish you could quit your job, and trading options might be a path to that goal, but it would be very difficult to give up your job even if you were able to have some big winning trades. There is no reliability in that plan. It would be critical to create a constant stream of profits to build the confidence to perhaps one day quit your job. So the Options University Bootcamp will also teach you lower risk strategies designed to capture consistent profits. You will learn such classic techniques as covered call writing, but I will show you my special way of doing them that nobody else teaches. My flavor of these techniques should create much, much higher returns, but with no more risk. One of my favorite techniques is delta neutral trading. In this method, we are focused on trading the implied volatility of the option. We pretty much don't care which way the stock goes. We start the trade with no real directional bias. We don't care which way it goes. And then we will generally stay with no bias as the trade develops. You see, trading a delta neutral strategy is all about finding options that are undervalued and buying them, or finding overvalued options and selling them. If done correctly, this strategy will create a powerful stream of profits in a consistent manner. This was the key strategy I used when I was a professional options dealer. I made literally millions of dollars using this strategy, and now I want to share it with you. You see, options trading has the potential to create massive profits and consistent profits, but it has to be done right, or the leverage of options can really hurt your bank account. It's important to learn how to trade correctly from experienced traders to make sure you're not sabotaging yourself. The Options University Bootcamp can provide that expert instruction. One of the cool benefits of the bootcamp is that we will be live trading all the strategies we teach. We use real money and trade the positions live in front of you using my money. We believe that actually trading during the bootcamp will dramatically accelerate your learning and should get you into the profit camp quicker and help you create massive profits quicker as well. The Options University Bootcamp is taught by super experienced instructors, including myself. Our instructors all have a minimum of 8 years experience. In addition, we have the world's greatest expert on binary options, Abe Kofnis, teaching us how to use binary options, the hottest new thing in options, to make money in a week, a day, and even in an hour. He literally wrote the book on trading binary options. And if you come to this course, we'll give you a copy of his book. Ian Cooper is perhaps the greatest expert on trading options on biotech stocks. He will show you how he picks the stocks and then his very clever strategy for making money in options on biotech stocks. You will learn at this 5-day live bootcamp what are options, how do you open a brokerage account, and how do you trade them, how to know when to buy and when to sell options. Can covered call writing make 100% per year? Using vertical spreads to make 5% per week. How to make money and not care where the market goes. The key myths about options trading. How to pick stocks for immediate and powerful advances. How to trade options then on those stocks that are making those immediate and powerful advances. How to use options with boing boing. You're saying, hey, I don't know what boing boing is. Yeah, but I'm going to teach you What Boing Boing is, once again, a proprietary trading technique that I use to help create my amazing track record. But there's more. We're going to talk about how to trade volatility with butterflies and condors, how to trade time through calendar spreads, how to trade binary options to help make money every hour, how options and biotech stocks make the perfect couple, how to use options to repair a losing stock position. Now, this is really a totally comprehensive course designed to teach you super cool trading techniques to take your trading to a much higher level. I don't believe that you can get this powerful information in such a condensed and useful course anywhere in the world. I also don't want you to take a risk on this course. So I'll offer you a simple yet powerful guarantee. I will cheerfully refund your money if this is not the best options seminar you have ever taken in your life. It's that simple. It's got to be the best, or just ask for your money back and we'll give it to you. No quibbles at all. Take the course. Try everything for 30 days. Then simply ask for your full refund if you're not completely satisfied. I can't really make it much better than that. I can't really eliminate the risk better than this. Taking the course is now a risk-free trade. I've taken the risk out of taking the course. I have to warn you, though, that seats are limited. You see, we built a classroom to teach investing in our office in Las Vegas. So it's got, everybody has their own computer, everybody has their own quote screen. We've got big screens for the teacher to use. The thing is just completely tricked out for teaching trading. We wanted to create the best learning experience in the world for learning how to invest. Investing is hard enough. We didn't want you to have to think or worry about anything else, so we put together this amazing classroom. But the problem is that there's only 36 seats in the room. We know that they're going to sell out quickly. We know that with only 36 seats and with this amazing classroom and with this amazing course and with these amazing instructors, that every time we offer this, we believe that this room will sell out. We've made it a small room so that everybody's going to have an amazing learning experience, learning how to make money in the options market. So be sure to sign up right now to make sure you get a seat. Seats are first come, first served, so please sign up right now. Don't delay it any longer. Sign up right now to make sure you get that seat. It's important that you sign up right away. Simply click the link on this page to now guarantee your seat. If you don't click the page, who knows if you're going to get a seat to this amazing boot camp. I really want to see you at the Options University Boot Camp, so sign up now and start learning the most powerful techniques for trading options in the world. I'll see you there. Thanks very much.